Hello everyone, this video is about the physical stock take and the stock loss and stock gain that we record as a result of this. So first of all, we're talking about the stock cards recording every transaction. So the idea is that this provides a continuous system for us. It's called the perpetual system of stock recording, where we have all the transactions that happen in the stock cards and then we conduct a stock take and verify the balances. So essentially perpetual is continuous, it's ongoing. So the balance of the stock card should show the quantity of stock on hand. The idea is that when we're completing these stock cards, all of the movements in and out of stock are recorded. However, this isn't always the case. And that's where we talk about stock loss and stock gain. So things like human error can always affect how stock is recorded in the stock cards and therefore the accuracy of those stock cards. So it needs to be periodically checked through conducting a stock take, which is the physical count of the number of units of each line of stock on hand. So each item of stock needs to be counted. The count is then compared against the balances in the stock card. And that's going to be able to verify the accuracy. If the count is the same as what's in the stock card, it means that we have the right number of stock recorded. If not, we're going to need to record a stock gain or a stock loss. So the issue with the stock take is it is very timely and is very costly, and therefore it's only going to be done relatively infrequently. So it's not one of those sort of things that wants to be done every day. We're going to do it at the end of a reporting period at the very least. So reporting period or potentially the end of the whole year. Okay, so if we're talking about stock loss, it is an expense. Please remember that stock loss needs to be recorded as an expense. It is incurred when the number of stock items counted is less than the quantity shown on the balance of the stock card. It's an outflow of economic benefits, stock that's decreasing assets, the asset being stock, and also reduces owner's equity. So this is why it is an expense. Stock is lower than we thought it was going to be, so therefore we need to decrease that stock. There are a number of reasons why it can occur. Someone's stolen something, someone's damaged or broken something. Suppliers have ordered. We've ordered from suppliers and they haven't supplied us enough, or we've given too many to the customer accidentally. So I'm going to go through an example. This is a stock card. On the 31st of August, you have got 3 terracotta pots on hand, memo 19, but in the stock card, there are 5 pots on hand. So we go down to have a look at this. On the 23rd, that's the last time there was a transaction that happened in the stock card. Therefore, as at the 31st, we would expect there to still be these 5 units of stock at hand. However, when we actually did the stock take, we realized that there were only 3 units of stock on hand. Therefore, as it says up in here, revealed a stock loss. So if we go back up to the definition of stock loss, the expense, the number of stock items counted, 3, is less than the quantity shown on the balance of the stock card. The stock card was 5, so the number counted was less than what's on the stock card. Therefore, we have a stock loss of 2. Stock loss is always going to sit in the out column. We are taking items out of the stock card. We want to make it smaller, therefore it needs to sit in the out column. Anything that goes in the out column is always going to be calculated at FIFO. So stock loss always uses FIFO. The first in is first out. So the first in is the one that we use for the stock loss. It just talks about here, FIFO assumption. The business thought that there was 5 units on hand. They actually only had 3 units on hand, a decrease of 2. Stock loss is always recorded in the out column. Okay, because there is no sale of stock on credit and there are no transfer of cash, stock loss is recorded in the general journal. It's an infrequent non-cash transaction. Therefore, we put it in the general journal. Our stock loss expense is going up. To increase an expense, we need to debit the amount. Our stock control is going down, therefore we need to credit it, decreasing an asset. We know that it's 140 because we've worked it out in the stock card. So we had 2 at $70, which is $140. That's the amount we then transfer to the stock card, sorry, to the general journal. Now please, the narration needs to include the stock code and the number of stock items that have been lost, as well as the memo number. So you need to include all of these things in your narration for it to be correct. Otherwise, you won't get marks for it. The general journal entry will be posted to the general ledger at the end of the month, just like we always do. We've always posted the general ledger at the end of the month. To have an example, this is the stock control. We are decreasing stock control, so it's a credit entry. Therefore, our credit is going to be the 140. The other side, the debit as a result of this credit is stock loss. Therefore, we put this in our cross-reference. Stock loss, it is a debit because it's an expense and it's increasing. If it's $140 on the debit side, we have our stock control as our cross-reference because it is the credit entry as a result of this debit entry. So this is an example here of using the FIFO assumption for first in, first out. So on the 30th, we had this many items. So we had 19 items on hand. We then had a stock loss of 2 when we actually counted. So the 2 are the first in, first out. So we're saying that this was first in. So we've got our 80 has to be first out because this is the top one and 2 of it there. So we're decreasing this top one. So then we have 2 left rather than 4 and still have the 15 at $90. So exactly like we would use FIFO in a sale, we use it in stock loss as well. Okay, stock gain. This is a revenue. When the number of stock items counted at the stock take is more than the quantity shown in the balance of the stock card. It's an inflow of economic benefit that increases our assets, so stock is going up, which results in an increase in owner's equity, net profit. So the definition of a revenue and why this fits to it. This can occur if there is an oversupply from a supplier, so the supplier is given more than what we ordered, or an undersupply to a customer, so that we've charged the customer for a certain amount but only supplied them less than that. So we'll go through an example. On the 31st, the stock take revealed 35 pairs of gardening gloves. The stock card, however, showed 27. So there was a stock gain of 8. So the stock take is higher than the stock card, therefore we have a stock gain. So the business thought there were 27 units of stock on hand. They actually had only 35. An increase of 8. So stock gain is always recorded in the in column because the balance needs to be increased. So we can see that here. We've got our 27 units on hand before the stock take was done on the 23rd. Nothing's been recorded since then. Then when we actually went and counted, we realized we actually had 35 units on hand. So we need to increase our stock card by 8 to make sure our balance is sitting at 35. So in order to satisfy the demands of conservatism, any stock loss that's put back into the business must be valued at the lowest price of stock still on hand. So if we had more than one price outstanding, say for instance, if it was this item here, the 10 and the 12, our stock, excuse me, our stock gain would be valued at the $10. So it's the lowest price of stock still on hand. It ensures that the assets and the net profit are not overstated per the conservatism principle. Because there is no purchase of stock on credit and there's no transfer of cash, stock gain is recorded in the general journal. It's an infrequent non-cash transaction. So we've got our stock control going up because we're increasing the amount that we have in our stock card. So we've got a debit because we're increasing the stock, increasing an asset needs to be debited, and a stock gain revenue. To increase revenue, we need to credit it. So we know it's 96 from the stock card. $96 based on our cost price. We need to make sure our narration includes the stock code, the number of stock items gained, as well as the memo number. Please do not forget. Okay, so now we're going to have a look at stock for advertising purposes or drawings. Business can take stock out for display purposes, or donate the stock to events, or hand it out at different events to ensure that they're advertising their product. In either of these cases, or in all of these cases, the business would treat this stock for advertising purposes. So we've got an example. On August 15, 3 wheelbarrows were donated to the local fete. Firstly, this was recorded in the stock card. So that's step number 1. The stock is leaving at the business, therefore it has to be in the out column. When we're reducing the amount of stock, it needs to go in the out column. So 3 wheelbarrows, we had 2 at $80 and 10 at $95. So on the 15th, we need to use FIFO because, like I said, the out column always uses FIFO. So we've got the 2 at $80 going out and then the 1 at $95. So we've got 9 left at $95. As I said here, also using the assumption of FIFO. So the out column always uses the FIFO assumption. Again, it's an infrequent transaction and it's non-cash because it's just a movement of stock. Therefore, we record it in the general journal. So if we go back up and have a look, we've got 160 plus 95 in total is what this advertising cost us, or the donation cost us. So $255 in total. So advertising is an expense. It is going up. We are increasing the amount that we are advertising, and it's $255. Stock control is going down. We are giving away these wheelbarrows. Therefore, it needs to be credited. The asset is decreasing, so it needs to be credited. So it's then posted to the general journal at the end of the month. General ledger at the end of the month. This is the general journal. This is the general ledger. So we can see stock control is going down because we're giving it away. Therefore, it needs to be credited. The debit as a result of this credit is in the advertising. So advertising is the cross-reference. Always make sure this is at the end of the month. So in our general ledger, we're not going to see anything other than the first and the last day of each month. Advertising has gone up, the advertising expense, therefore it needs to be debited. As a result, the credit as a result of this debit is at stock control, so therefore that is our cross-reference. This is exactly the same as what happens for drawings. So if the owner takes money out of the business, drawings is going to go up, stock control is going to go down. The memo, it needs to state exactly what's being taken out of the business, the number, the stock number if you have it, and the memo number. So this is a flow. So we have our memo, we record it in the stock card, we record it in the general journal. We need the stock card first because we need to know how much that donation cost us. Then we record it in the general journal. Then at the end of the month, it's posted to the general ledger. Please make sure you understand this, because if you don't understand this, everything before is going to be really confusing. So maybe it's an idea to write a few things down about what happens at each process. So the stock card needs to use the out column, it needs to be FIFO. The general journal needs the stock card because it needs to have the cost price to be able to record it. This needs to be posted at the end of the month. All of these types of notes that are going to be made around this are going to make it significantly easier for you to remember what's happening up here. Okay, I'm going to pause the video here. I'm going to do one more very quick video about reporting.